Welcome to Breaking News to Trading Moves. Let's start with a scenario. Imagine a premier blue chip company announces record profits, beating every estimate on Wall Street.
Right. And the stock ticks up what, maybe 2%?
Exactly, maybe 2%. Now, imagine a distressed, near bankrupt company announces they, merely survived the week. And the stock explodes 40% in a single hour.
It defies all conventional logic.
It really does. If you're listening to this and you've ever tried to short a dying stock right at the bottom, only to have your face ripped off by a violent rally, well, this is exactly why we're exploring this topic today.
It really is one of the most counterintuitive phenomena in markets. You have these assets that appear entirely broken, yet they snap back with a ferocity that leaves traditional valuation models in the dust and leaves traders completely bewildered.
Right, which brings us to the central debate today about market structure and price action. Is the extreme velocity of these rebounds in distressed stocks primarily a product of mechanical market structure? Things like liquidity, stretched positioning, and forced short covering? Or is it predominantly driven by behavioral psychology and emotional transitions among traders?
The core question, yeah.
I maintain that these explosive bounces are inherently mechanical. They're driven by the sheer math of stretched, one-sided positioning and incredibly thin order books. Weakness in a stock doesn't mean it's dead, it just means the asset is mathematically compressed.
And I maintain that those moves are intrinsically psychological. Yes, the structural plumbing of the market is present, but it only matters because of the underlying emotional panic that preceded it. These massive rallies are fueled by the rapid emotional rotation from maximum pessimism to sudden relief. The physical mechanics you describe are just the vehicle. The engine is the human transition from outright fear to reflexive greed.
Well, let's look at the mechanics first, because I believe the structural reality dictates the outcome regardless of how traders feel on any given Tuesday. When a stock experiences a protracted decline, the broader market assumes it's just a failing asset.
Right, naturally.
But structurally, what's actually happening is that the asset is becoming mathematically compressed. We see oversold conditions that create incredibly stretched, one-sided positioning.
But you can't separate the math from the minds executing the trades. The mechanical factors, like the thin order books and the high short interest, they only exist because of a preceding emotional capitulation.
I disagree. The math operates independently.
Hold on. The psychology plays the defining role here, because market participants move from terror to relief extremely rapidly. After an extended period of selling, the downward pressure evaporates simply because everyone who is terrified has already hit the sell button.
Yeah.
But that exhaustion is an emotional state, not just a mathematical one.
Wait, so you're saying the math is entirely secondary without a psychological trigger, even when algorithms are executing the bulk of these trades?
Yes, absolutely.
Well, let's focus on the first major point of contention here, which is the spark versus the powder keg. You're talking about exhaustion as an emotional state, but I look at it as a clearing of the order book. After a washout phase, we get a clean slate of positioning.
A clean slate, sure.
Right. The short interest is high, and the order book is exceptionally thin on the ask side. That structural setup acts as a literal powder keg. When selling pressure fades, the lack of liquidity means that price discovery becomes terribly inefficient.
Inefficient, yeah.
The price is forced to spike rapidly on minimal buying because there are simply no limit orders resting above the current price to absorb those buy orders.
I come at it from a different way. A powder keg doesn't ignite itself. To get that aggressive repositioning into beaten down names, you require a narrative catalyst.
Not always.
Usually you do. That could be a broader sector rotation, a piece of macroeconomic relief, or a very slight positive surprise in the company's earnings. A positive surprise acts as a catalyst precisely because the baseline sentiment is so extremely negative.
Right, the bar is low.
Exactly. The market is pricing in imminent bankruptcy, and the company announces they have enough cash to survive another quarter. The relief is palpable. That narrative change is what triggers the aggressive repositioning. Without the psychological jolt, your thin order book just sits there, completely stagnant.
I just don't buy that. Let me tell you why. You're assuming the catalyst needs to be tied to a logical narrative or, a human feeling of relief. I've watched countless distressed stocks explode upward 30 or 40% on literally zero news.
Zero news?
Nothing. No macro relief, no earnings surprise. It happens because of the underlying plumbing. Think about an empty order book like a highway at 3 in the morning. When the road is empty, a single car can go 100 miles an hour effortlessly.
Sure, but a car still needs a driver.
A purely algorithmic mean reversion strategy executes a standard buy order. And because the structural liquidity is completely hollowed out, that standard order eats through 5 levels of the order book instantly.
But algorithms don't sustain a multi-day rally.
They don't have to. They just start the mechanical cascade. That initial upward tick immediately triggers the automated stop losses of retail short sellers. When their stop losses trigger, they're forced to submit market buy orders to close their short positions.
Right, the short squeeze.
Exactly. And those market buy orders eat through the next 10 levels of the order book. And here's where we have to explain the actual mechanics of dynamic hedging. When the stock starts moving, retail traders rush in to buy cheap call options.
Driven by FOMO.
Driven by the price action, the prime brokers selling those options take on massive risk. To protect themselves, the brokers are forced to buy the underlying stock in the open market. They aren't buying because they believe the company's narrative is improving.
No, they're delta hedging.
Right. They're buying purely to balance their own math. It is a forced cascade of automated mechanical execution. At no point in that chain of events did anyone feel relief.
Okay, that's a compelling argument regarding the microstructure, but you're describing a momentary flash. Sustained dead cat bounces, the ones that recover major ground over days or weeks, those require active human participation.
I don't think they do.
Algorithms might ignite the very first match, but human greed pours the gasoline. But wait, if the order book is a powder keg, who is actually lighting the match on the demand side? You focus heavily on the mechanical constraints of supply, but I argue you're vastly underestimating the reflexive behavior of new buyers.
The supply constraint is the entire ballgame. Let's talk about the psychology and mechanics of the current holder. We have to look at anchoring bias.
Okay, anchoring to what?
In a distressed stock, the overwhelming majority of people who are still long on the asset are deeply underwater. They bought at $50 and the stock is now trading at $5. They are trapped.
Right.
Mechanically, this creates a major supply constraint because these underwater holders are far less likely to sell into an early rebound.
Because they're waiting to break even.
Exactly. They anchor to their original purchase price. If the stock bounces from 5 to 8, they don't sell. They withhold their shares from the market, waiting for it to get back to 50.
Yeah, which restricts the float.
Because they withhold that supply, the available float remains incredibly restricted. Therefore, when any new buying pressure arrives, the buyers are forced to pay consistently higher prices because the current holders refuse to provide liquidity. The lack of supply forces the volatility to expand upward.
Well, that makes sense in theory, but look at the actual behavior of the market. A lack of supply is completely irrelevant if there's no aggressive demand. A stock can have 0 sellers and still never move up if nobody wants to buy it.
True, but
The true velocity is driven by active momentum buyers and retail traders who are actively chasing the rebound. Look at the historical examples from the retail trading frenzies of the past few years. Traders pull up a chart. They see a stock that used to trade at $50, now trading at $5, and their brain perceives it as a visual discount. They don't care about the order book mechanics or dynamic hedging. They care about the perceived bargain.
But that visual discount is an illusion based on past pricing.
Exactly. And that illusion drives real money. As the price starts rising from 5 to 6 to 7, the fear of missing out takes over. This is reflexivity in its purest form.
I mean, I wouldn't call it pure reflexivity.
The rising price actually changes their perception of the asset's viability. They convince themselves that the worst must be over simply because the line on the screen is moving up. It's the new, emotionally driven buyer that provides the relentless demand necessary to sustain the explosive velocity. The math alone doesn't create FOMO.
I see why you think that, but let me give you a different perspective on how that demand operates. That retail demand only creates extreme velocity because of the mechanical environment it enters.
How so?
If that exact same retail demand entered a high-quality, stable stock, you would barely see a blip on the chart. This contrast is vital. Why does a strong stock rally differently than a weak stock bounces? I maintain it's entirely about the ownership structure and the efficiency of the order book.
Okay, contrast them for me.
High-quality stocks are widely owned by major institutions, mutual funds, and pension funds. That ownership structure guarantees a constant, steady pressure of profit-taking.
So you're saying the institutional money acts as a ceiling?
It acts as a governor on the engine. Let's go back to our highway analogy. A high-quality stock is the highway during rush hour. Institutional portfolio managers have strict risk management mandates.
Right.
If a massive tech company becomes too large a percentage of their portfolio, they are mechanically required to trim their positions to maintain balance. This creates a dense, thick order book on the ask side.
So there's always supply.
Exactly. Every time the strong stock moves higher, it absorbs limit sell orders from funds locking in profits. It makes the rally smoother, highly controlled, and incredibly efficient. There's traffic at every exit slowing the price down. Distressed stocks lack that institutional ownership, so they lack the mechanical friction, allowing for uninhibited upward explosions.
Your description of the institutional mechanics is accurate, but I think you're drawing the wrong conclusion from it. The difference between a high-quality stock and a distressed stock is once again rooted in psychological baselines.
Psychological baselines?
Yes. High-quality stocks carry remarkably high expectations. The market assumes they will execute perfectly, grow their earnings, and dominate their sector. Because the baseline of expectation is so elevated, any positive news delivers very little incremental impact.
That's true.
If a tremendous company beats its earnings target by 2 cents, the market reaction is muted because perfection was already priced into the minds of the traders. There's no element of surprise.
And the distressed asset operates at the opposite extreme.
Precisely. The baseline expectation for a distressed asset is utter ruin. The market has priced in total failure. Therefore, any news that suggests the company might merely survive is treated as a spectacular victory.
A victory relative to zero? Sure.
Exactly. The biggest moves in financial markets don't come from comfort zones. They come from extremes. Maximum pessimism is the true driver of explosive velocity. When everyone is braced for a total collapse, the psychological relief of avoiding that collapse creates a euphoric rush. The strong stock grinds higher because people feel comfortable. The weak stock explodes because people are oscillating violently between panic and euphoria.
That makes for a compelling narrative. But let's look at what this actually means for someone managing risk in the market right now. You say strong means comfortable and weak means panicked. I argue that strong simply means efficient and weak means compressed.
Okay, but how does that change the approach?
When we analyze the trading implications of this debate, the central takeaway is that market participants must align their strategies with the actual behavior of the asset class. Mean reversion strategies operate entirely differently from momentum strategies.
Right, totally different tools.
If you're trading a distressed asset, you aren't trading the company's underlying business. You're trying to capitalize on structural and liquidity inefficiencies. You're exploiting the fact that the order book is compressed and that short sellers can be mechanically squeezed.
Well, I agree that aligning strategy with behavior is the most crucial takeaway. A weak stock isn't automatically a bad trade. The context of the environment matters far more than the generalized perception of the company.
Exactly.
However, the best rebounds consistently occur after maximum pessimism is reached, not after stability returns. If you wait for the mechanics of the company to actually stabilize, you will miss the entire explosive move.
You'll be too late.
Right. The opportunity lies in identifying the extreme negative sentiment and positioning yourself for the emotional reversal. But I must add a severe warning regarding risk management here.
Go on.
Because these moves are fueled by emotion and reflexive chasing, they're incredibly fragile. If the bounce thesis breaks, if the narrative adjustment fails to hold, or the broader market environment worsens, these weak stocks can fail much harder than they bounced.
Oh, absolutely.
The emotional support vanishes instantly, and the same panic that drove the initial washout will return with a vengeance. High-quality stocks are better suited for long-term trend following because the psychological expectations are anchored in reality. Distressed stocks are vehicles for capturing brief, violent emotional rotations.
Your warning regarding risk management is entirely valid, though naturally I trace the fragility back to the mechanics rather than the emotion.
Of course you do.
Well, the distressed stock can fail harder because just as there was no liquidity on the way up, there will be no liquidity on the way down. The vacuum works in both directions.
That is a fair point.
When the automated buying stops and the short sellers finish covering, the order book remains totally hollow. Any sudden selling pressure will cause the price to gap downward just as violently as it gapped upward. Volatility expands symmetrically after capitulation phases.
It cuts both ways.
Exactly. It increases the upside velocity, which is exhilarating, but it equally increases the downside risk, which can be absolutely devastating to a portfolio.
We're arriving at a shared understanding here, even if we take different paths to reach it. We both recognize that understanding the specific context of a stock is far more crucial than relying on simplistic labels like weak or strong.
Absolutely.
Whether you view it as a hollowed-out order book lacking limit orders or a landscape of extreme pessimism, the outcome is a highly volatile, highly reactive asset. The market isn't a monolith.
Exactly. Strong doesn't mean explosive. It often means structurally efficient and burdened by continuous institutional rebalancing. Weak doesn't mean dead. It often means mechanically compressed and primed for a forced liquidity event.
Right.
As we summarize our positions, I return to the sheer mathematical reality of the market. The physics of the dead cat bounce rely on the lack of resistance. When short sellers are forced to cover into an empty order book and prime brokers are forced to dynamically hedge, the resulting upward velocity is a mechanical certainty. The asset behaves like a tightly compressed spring released in a vacuum.
And I remain steadfast that the mechanics are always subordinate to the human element. The order book is only empty because human beings panicked. The short sellers are only forced to cover because human perception transitioned from fear to relief, driving new demand into the market.
It's the psychological elasticity, the rapid snap from despair to greed, that provides the true force behind the move. Without the emotional extremes of the traders executing the orders, the mechanics sit idle.
It's a phenomenal tension between the structural pipes of the market and the water that flows through them. We encourage everyone listening to evaluate the balance between market mechanics and human psychology within their own risk management frameworks.
There's always more to explore.
There really is, especially in how these two forces interact during extreme market events. The next time you see a beaten down asset double in price in an afternoon, think back to that tightly coiled spring. Are you trading the tension of the metal or the panic of the hand holding it?